Welcome to Yield, the Chronicles of Financial Markets. Today, we're going deep into an incredible story: how Harvard transformed a modest $4.7 billion at the end of 1985 into over $50 billion by 2025.
That's right. It may sound like an extraordinary tale of luck or massive donations, but it's actually a story of disciplined mathematics applied over 4 decades.
And what's fascinating is that the formula they used is public. So, why aren't more families or investors applying it?
Precisely. The formula is simple: capital at time t plus returns minus spending plus donations. It's a straightforward equation, but the real challenge lies in the discipline required to implement it correctly.
Could you break down that equation a bit for us?
Sure. It boils down to k t plus 1 equals kt 1 plus r s plus d. Here, r represents the gross return, s is the spending rate, and d is net donations. Over time, a 5% net return could theoretically multiply your capital by 7 times in 40 years.
That's impressive. But what's the underlying philosophy behind this thrive for such returns?
Great question. This philosophy draws heavily from David Swensen's work at Yale, which emphasizes thinking like an institution. Swensen's pillars include owning equity biases, understanding illiquidity premiums, and managing top-tier investment managers.
The 5 pillars you mentioned sound crucial. Can you elaborate on them?
Definitely. First, equity bias is about owning the broader productive capacity. Second, the illiquidity premium rewards investors for locking their capital in private assets for a longer time. The zero home bias means geography doesn't matter, cash flow is key. Next comes manager selection. It's more strategic to find top-performing managers than chase stock picks. Finally, rebalancing with discipline is vital, where you'd sell what's performing well and buy what seems undervalued.
This philosophy has a lot to do with patience and long-term vision, doesn't it?
Absolutely. One of the reasons individuals or family offices struggle is they lack that institutional discipline. They often overspend in good years or panic and sell during downturns, which can lock in losses and derail their compounding machine.
It's almost like a mental game, where your behavior needs to align with the financial strategy.
Exactly. It requires a governed approach, much like a university's investment committee would employ. A family of wealth needs that kind of governance to survive economically across generations.
So, what are the key takeaways for high net worth individuals aiming to replicate Harvard's success?
First, shift from an income-focused mentality to an endowment mindset. That means considering how to grow capital over spending it. Second, focus on long-term appreciation, not just immediate yield. Lastly, maintain that allocation discipline, invest during downs and avoid emotional decisions.
The numbers speak volumes. A family with $100 million could potentially grow that to over $1 billion over a generation if they follow these principles.
Precisely. It really underlines how capital can impact future generations. Building a perpetuity machine is the ultimate goal.
Thank you for shedding light on this fascinating topic. It's a reminder that successful investing is as much about discipline and strategy as it is about mathematics.
Thank you for having me. Remember, it's not just the math that works, it's having the temperament to let it.
That's a powerful takeaway. Don't forget to subscribe for part 2 of our series on institutional capital strategy. Until next time.